Imagine if you could turn a small weekly savings habit into a six-figure nest egg by the time you retire. Today, we're diving deep into how compound interest makes that possible, showing you real examples and strategies to harness its power. Compound interest is like a snowball rolling down a hill. Once it gets going, it picks up speed and grows bigger and bigger. Here's how it works. When you invest your money, you earn interest on the principal amount initially invested. But here's the magic part: over time, that interest also starts earning its own interest. This continuous growth is what makes compound interest so powerful. Let's say you start with just $1,000 and earn an annual return of 7%. After 1 year, your investment grows to about $1,070. But in the second year, you're not just earning 7% on that original $1,000. You're earning it on a new total of $1,070. So at the end of 2 years, your initial $1,000 has grown to about $1,145. Now, imagine if you keep this up for many more years, with that growth snowballing year after year. It's like planting a seed now and watching it grow into a massive tree in decades to come. The longer you let compound interest work its magic, the bigger your returns will be. And the best part? You don't have to do anything extra except wait and watch as your money grows exponentially over time. Let's dive into a practical example to see how compound interest can work wonders for your savings over time. Imagine you're 25 years old and you start saving $100 every month in an investment account that earns an average annual return of 7%. That's about $1,200 per year. Now, if you continue this for just 10 years without adding any more money, by the time you're 35, your initial contributions would have grown to roughly $19,000. But here's where compound interest starts making a real difference. After another 10 years, at age 45, that same account could be worth around $67,000. You might think, wow, I only put in $24,000 over 20 years, and it's now worth nearly triple that amount. But wait, let's fast forward another decade to when you're 55. At this point, assuming the same rate of return and without adding any more money after age 35, your initial investment would be worth approximately $184,000. That's a huge leap from where we started just by letting compound interest work its magic over time. Now imagine if you continued contributing that $100 each month all the way until retirement at age 65. You'd have saved about $36,000 in total contributions, but your account could be worth around $420,000. That's an incredible return on a relatively modest monthly investment. So, remember, even small regular savings can grow into substantial sums thanks to the power of compound interest. The key is starting early and being consistent with your investments. When it comes to investing and saving for your future, starting early can be a game changer due to compound interest. Imagine you're 25 years old and you start putting away $100 each month into an investment account that earns an average annual return of 7%. By the time you're 65, assuming no changes in contributions or returns, your initial investment would grow to around $439,000. Now, let's say your friend starts saving at age 35 with the same monthly contribution and earning the same rate of return. They end up with about $172,000 by age 65. That's a significant difference just from starting 10 years earlier. The reason is simple. Compound interest allows you to earn returns not only on your original investment, but also on any accumulated earnings. When you start early, those initial contributions have more time to grow and generate additional gains through compounding. This extra growth period can lead to substantial differences in the final amount of money you accumulate over time. Starting early isn't just about putting away a little bit of money. It's about giving that money the longest possible runway to grow exponentially. Even small adjustments, like increasing your contributions by 1% each year or starting earlier than planned, can make a huge difference in how much wealth you end up building for yourself and your future. So remember, whether it's $50 or $500 per month, every dollar counts when you start early. Your investments will benefit from the magic of compound interest over many years, potentially turning small contributions into substantial savings by retirement age. Now, let's talk about how you can boost your compound interest even further by increasing your contribution amounts. Imagine you start saving $200 a month at age 25 and earn an average annual return of 7%. By the time you're 65, you'll have roughly $500,000. But what if you increase that monthly contribution to just $300? That extra $100 per month can turn into more than $1 million by retirement age, thanks to the magic of compound interest. The beauty of increasing your contributions is that it doesn't require huge sums of money. Even small increases can have a significant impact over time. Let's say you're already contributing $250 monthly and decide to add just another $50 per month for 40 years. That additional $6,000 in contributions could grow into an extra $187,000 by retirement, assuming the same 7% annual return. Think of it this way. Every dollar you put in now is not only earning interest, but also setting up future dollars to earn even more. So if you can find room in your budget to increase your contributions even slightly, you're making a powerful move for your financial future. Remember, the earlier and more consistently you contribute, the bigger the difference those extra dollars will make down the line. In summary, increasing your contributions is one of the most effective ways to supercharge your savings growth through compound interest. Every little bit helps, and it's worth finding that extra cash to put towards your retirement fund. Now, let's dive into how often interest is compounded and why that matters for your savings growth. Imagine you have $10,000 in a savings account with an annual interest rate of 5%. If the interest compounds annually, it means you earn interest once at the end of each year. But if it compounds monthly, you earn interest every month based on the balance after the previous month's interest. Here's how it plays out. With annual compounding, your $10,000 grows to about $10,500 by the end of the first year. However, with monthly compounding, that same initial amount would grow slightly more each month because you earn interest on the accumulated interest from previous months. By the end of 1 year, your $10,000 would be worth around $10,512 under monthly compounding compared to just $10,500 with annual compounding. That extra $12 might not seem like much now, but over decades, that little bit can really add up. The key takeaway is this: the more frequently interest compounds, the faster your money grows. So always look for accounts and investments where interest is compounded monthly rather than annually to maximize your returns over time. Now let's talk about inflation and how it affects your savings over time. Inflation is the gradual increase in prices for goods and services, reducing the purchasing power of money. Imagine you have $100 today, which can buy a lot of items at the store. But due to inflation, that same $100 might only buy 95% of what it could last year. Over decades, even small annual increases in prices like 2% per year can significantly erode your savings value. To combat this, you need investments that grow faster than inflation. Historically, stocks have provided average annual returns around 7%, while inflation averages about 3%. So if you invest $10,000 today and earn an average of 7% annually over 25 years with an inflation rate of 3%, your initial investment would grow to roughly $46,000 in real terms after adjusting for the cost of living increase. This is why investing early and letting compound interest work its magic can be so powerful against inflation. Remember, while higher returns offer better protection from inflation, they also come with more risk. It's crucial to balance your investments according to your age, risk tolerance, and financial goals. By doing this, you ensure that the growth of your savings outpaces rising costs, securing your future wealth. To maximize your returns on compound interest, you need to focus on a few key strategies. First, make sure you're investing in accounts that offer higher interest rates. For instance, high-yield savings accounts can yield around 1% to 2%, while some certificates of deposit, CDs, might give you up to 4%. Another crucial step is to automate your contributions. Set up regular deposits into your investment or savings account so you never miss a payment. Additionally, try to increase the amount you contribute over time as your income grows. Even small increases can have a significant impact on long-term growth. For example, if you start by contributing $100 monthly and bump it up to $200 in 5 years, that extra contribution will compound for decades, leading to substantial gains. Don't forget about the power of tax-advantaged accounts like IRAs or 401ks. These accounts allow your money to grow without being taxed until you withdraw it, which can significantly boost your returns over time. Finally, consider diversifying your investments. While high-yield savings and CDs are great for safety and liquidity, putting some of your funds into stocks, bonds, or mutual funds can lead to higher long-term growth potential. Just remember to balance risk with your financial goals and comfort level. By implementing these strategies, you'll be well on your way to maximizing the power of compound interest in your financial journey. So, there you have it. Compound interest isn't just a fancy finance term. It's your secret weapon for building wealth. By starting early and making small but consistent contributions, you can watch your savings grow exponentially over time. Don't forget to subscribe to Cash Decoded for more insights on managing and growing your money wisely.